Okay, if you ever been asking yourself, especially right now, how to actually invest in gold, silver, how to buy it, how to invest in mining stocks, this is the most common question that I get asked. So you're in a lot of luck today because I have one of the most well-known and successful silver, gold, and so far as natural resources, but most well-known, one of the most foremost experts in the world on gold and silver. His name is David Morgan. He's become a mentor of mine and someone I've built a relatively close relationship with. I'm a part of his paid group called the Morgan Report. This is not an affiliate promotion, and I'm not even accepting affiliate link. It's super cheap, $500 for a year, $50 a month. It should be more. I have probably 80% of my stock portfolio invested based off David's tips in there. So $50 a month for people that are interested. You'll see the link right there down below. David is most known for silver, though. He's appeared on all types of major networks from Fox and mainstream media when they have gold and silver taken off. And so we're in a lot of luck here to be talking about investing in gold and silver and how to buy it with one of the top experts in the world, David Morgan.
Well, Jake, thank you very much for having me, and I hope I can live up to that opening. But I certainly have spent a lot of time in the gold and silver space. There's no doubt about that. So I think let's just get right into it. I'm going to share my screen, and I'm going to show your viewers a few of the questions that come up all the time. And the first one, of course, is, what happened to gold silver ratio? And we can see somewhere around March 18th, we got a gold silver ratio of about 122 to 1. And all of recorded history, meaning in early Egyptian times, like 2500 BC or so, we were looking at a gold silver ratio about 2 to 1. It took 2 ounces of silver to buy 1 ounce of gold. And from that time until the late 1800s, the ratio never got above 20 to 1, meaning 20 ounces of silver bought 1 ounce of gold. And I did a whole video series of this, and I'm not going to ask you, Jake, to put all this in the show notes. Someone that's interested could play the video twice or maybe just once. But there is a lecture or two out there on the web, and it's titled something like, "What if silver were treated like gold?" And my whole premise on that is to make the argument that when silver and gold serve exactly the same function, and that's money and money only, nothing more, nothing less, no industrial, no reflective qualities, no heat qualities, no anything that silver's uniqueness provides in the technological modern world, none of that's accounted for. It's only counted as money. It has a far higher value than it does once it's demonetized, which happened officially in 1873. So having said that background, we also have never gotten above 100 to 1 ratio until very, very recently, as I
David,
said.
and what this means for people that the gold silver ratio, you really actually need to be a little bit, at least a little bit of a gold silver buff to even know what that means. So for people that aren't aware, what that means is the gold to silver ratio is how many ounces of gold. So this is 1 ounce of an American Eagle gold coin right now, which is roughly selling at $1,750. So what the gold to silver ratio means is how many ounces of silver versus gold. How many does it take to buy one versus the other? How many ounces of silver does it take to buy 1 ounce of gold? And he was saying historically it was around 20. And as we've really ballooned this economy, we're seeing it presently above 100. And that's what he's referring to. Take it away, David.
And both times it's been above 100, it's forecast a financial problem. I'll call it problem. And this time we're at a historic, which suggests that we're going to not only have a financial problem, but since it's the greatest in 5,000 years, perhaps the financial problem that we all face will be greater than the ones we faced when it hit the 100 to 1 ratio some time ago. I don't know. I'm just suggesting that's something to consider. I don't know. What I can tell you is that when we went off the bimetallic standard, it actually sets a precedence for something that is written by a gentleman that I'm reviewing his work again, and I just want to highlight this because, again, when silver is treated as money, it has far more value than it's treated as an industrial commodity. But he writes in this treatise about gold is fiat in disguise, meaning when you're on a monometallic standard or a gold-only standard, you have a problem eventually. And of course, we were on a gold-only standard. What he says here is that to have honest money, we have to have gold priced in silver, and silver is priced in gold, physical silver and physical gold. But once gold is priced in printed pieces of paper instead of pieces of silver, the honest money regime is gone. Even though the formerly silver and now fiat units of account are defined in weights of gold, because there is no natural limit on the overall amount of printed pieces of paper as there was an overall amount of pieces of silver. In other words, with silver and gold in the monetary
Come back onto the screen, David.
I'm sorry?
Come back onto full screen.
Oh.
Take screen share off. I want to ask you what you mean by that. So for people that right now what's happening is David's making he just said something that's really profound for why gold and silver are valuable. And what you were talking about was fiat currency. And when fiat currency comes into play, there's a devaluation of gold and silver. So what's the big deal with fiat? And can you elaborate on that quote that you just read to us?
Sure. The big deal at fiat's very simple. All fiat fails. 3 words. All fiat fails. I can't make it more elegant, more simple, and more direct than that. And that's absolutely a fact. If you look at Addison Wiggins, I worked for Agora, set himself or one of his associates on the task of looking at all of the fiat that had failed throughout history. And I forget the exact number, but the idea is correct. And he went through A and B as far as the names of the currencies. And by the time he got through into the letter C, it was something like 1,500 fiat currencies had failed. Every one has failed. Every single one. It's a 100% track record. There's no such thing as one that lasted. All of them failed. But look at gold. Gold has lasted since all of recorded history. Same with silver. Now,
why do they fail?
Huh?
Why do they fail?
Because it's a lie. Because you can't print wealth. If you could print wealth, Zimbabwe would be the richest place on the planet. Right? I mean, this is not all that basic stuff, and I know your audience is a lot different than mine, but, I remember when I've said this many times on other interviews, but, I don't know if you can see that because of the background. I think it cuts it out.
Put it a little bit more. Yeah, right there. Now you can see it. So what that isn't it a $100 million bill from Zimbabwe?
No, it's $100 trillion.
Holy shit. 100 trillion. So what we're saying here is gold and silver are coming back into relevancy because for the last however many years in this whole bull run that we've had in the mainstream stock market has been from printing infinite money, now 0% interest rates. A lot of the world is negative, and stock buybacks on incredible levels, where IBM, for instance, 90 cents of every dollar that they earned went back into stock buybacks. So they propped all this up. There's all this cheap money. And what you're saying here is that fiats fail because what happens is you can't print your way to wealth. And this is what is occurring. And the coronavirus has really been that thing that's really started to aggravate the bubble in our currencies that we've had, and why I've been talking so much about gold and silver on this channel and why they're coming back into relevance again. Is that an accurate?
Well said. Yeah, very accurate. Yeah, these concepts aren't really that difficult. It's just we're never taught about the real nature of the monetary system when we're in school. Even if you're a finance major, such as myself, they really never touch upon the gold question or any of this stuff. It's all basically about interest rates and the future value of money and on and on. I don't want to go down that rabbit hole right now. I want to stay more on point. So the idea that I just read that quote was that unless you have a physical constraint on the money supply, then you are going to have problems that you just outlined. So we don't have to go over that again. But what he's saying here is that when you have gold defined in units of silver, there's only so much silver that you can mine in any given year, and there's so much you can accumulate above ground. And that's a backstop. In other words, the gold-only standard supposedly says that you can only print so many pieces of paper per ounce of gold. And that's how we started after the Bretton Woods agreement. Basically, it was a world standard in a way. The dollar standard worked for the world. And the agreement was that 35 US dollars was the equivalent of 1 ounce of gold. And since they could really define gold in units of paper, they kept printing and printing and printing. But if they defined it in units of silver, you can't print silver. So the market would come in and say, wait a minute, they're pricing gold at this price. I'm going to swap silver for gold and gold for silver. I don't want to talk over anyone's head. You just have to think about this and come back to it. But basically, it means that they kind of balance each other. And this is what's happened throughout history. In fact, this whole paper talks about just a very slight difference in the amount of the shilling that was enacted under the Sir Isaac Newton time frame. But I don't want to go that deep. What I want to do is say that a gold-only standard is fiat in disguise. That's the name of the article. I didn't write it. It's really worth looking up. I'll just say it's gold standard with an equal sign, fiat in disguise, written by J as in Jerry, N as in Nancy, Tagla. It's Tlaga. Brilliant article. Anyone that really wants to dive deep, I suggest that you study that. So I like to move on, Jake, because I think I want to get just a little bit more on the practical side, if you don't mind.
Please.
Which means I just want to go back to the share screen here. And I should be sharing now, right?
Yep.
Okay, so let me just go to a couple of places here. And problem with this is I get this little thing. There we go. So the HUI is the Gold Bucks Index, and you can see my cursor. And what I'm showing here is we've basically gone way, way down. We've had pretty much this V bottom from here down and back up. So we're basically where we started just a few months ago. This is a weekly chart, by the way. So I told everyone that subscribes, as Jake mentioned he is, that when we were doing this and people were panicking because, you don't want to see those kind of moves in a few days or a week or two. It's very tough, very, very tough.
And what we're looking at is an index of all the gold stocks?
Correct. And thank you for saying that. Sometimes I get a bit carried away and I assume people
just remember my audience knows less about gold and silver than you do, and that's why
right. I do have that problem.
Like you're talking to, someone that is starting to open up to the possibilities.
Sure. And I'll try to do a better job because I can. So anyway, they are the most volatile asset class around, and we got this V bottom. It came right back up. So my point is that, you've got to be pretty well resigned to the fact that all stocks move up and down, and these are some of the most volatile, meaning they move the most up and down of any asset group out there. However, by telling everyone to hold, it actually went lower and it came right back up. So I just got a an email from one of our members that said, thank God that you said hold, because we're back up to here. And I have 2 other newsletters that I subscribe to, and both of them were selling down here at the bottom. And you told us to hold on.
And what he's referring to right now is we had a nice rally in gold that we've been having, but then once everything sold off during this coronavirus lockdown, when mainstream stocks sold off, gold sold off too, both physical silver and then also physical gold, physical silver, and then also gold stocks and silver stocks as well. And so what that was a reference to the index to see it sell off. And I almost shit my pants because I lost my portfolio when it sold off went down like 80,000. Now it went back up. I probably am up 15% already this year, for sure. And what he was showing was the catapult down and then the quick recovery because of people realizing all this money printing is bad. And that's why there's such a flood going into gold and silver, both physical and the stocks.
So this is what I started a long time ago, but it's still valid. And I kind of like the first one. When all else fails, there's silver. We're kind of in that mode right now. I'm not laughing because I think it's funny. I'm kind of hiding behind humor because, believe me, there's no one that's really wanted this to happen, but I did know that something along this would occur. Didn't know it'd be a pandemic, didn't know it'd be a virus, but I knew an economic collapse was inevitable and most likely in my lifetime. So here we are. So as I say here, no one likes to be a prophet of doom, but the simple truth is that silver is the world's money of last resort. And when I wrote that, this was published in a book called Investing Rules. And the editor of that book called me, and he doesn't call everybody that writes because they have a bunch of people that are in this book. And he said, I never thought of that before, but you're right. He was kind of taken back that something so obvious wasn't so obvious. Anyway, should a severe economic collapse occur, are we awake, folks? Am I making sense here? Leaving paper assets worthless, they're not there yet. Silver will be the primary currency for purchases of goods and services. Gold will be a store of major wealth, but will be priced too high for day-to-day use. Thus, every investor should own some physical silver and store a portion of it where it's accessible in an emergency. So that's rule number one. And I want to digress a bit here. And go to YouTube. So that is my YouTube channel right here. And on here, I want to find myths and silver. So called The Great Silver Market Myth. I'm not going to play it because I don't know if it'll come across a double video, but in this video, it's only 3.5 minutes long. Some of the most powerful 3 minutes you'll ever learn in your entire life about money and silver.
Explain.
Well, let me play it. And Jake, you stop me. If it plays, we'll play it. If it doesn't, we'll stop and talk about it.
Another myth that we have in the silver market, and this one you hear primarily from coin dealers, bullion dealers, especially those that are, maybe been chided in the last bull market when silver ran so quickly. Basically, in 1 year's time, from $6 to $50, a big move in a short amount of time. You'll hear, well, I think everyone should own a little. And what they're implying is that, everyone should have a little gold and silver. And they're really not that in tune with the global system or what's really going on. They may have been actually more so in the previous bull market. Regardless, it's one of mine that I love to dwell on. Everyone should have a little. Two very ambiguous terms. What is everyone and how much is a little? So in the context of everyone, we could think of every human being on the planet, and that would be over 6 billion people. But I'm going to narrow it down. We're going to use about 5% of the world's population, and we'll just say everyone in the United States. And that's round numbers, 350 million people. And now we need to define a little. How much is a little? Well, I'm not going to use 1 ounce as a little because 1 ounce at the time we're doing this is about $30. And I don't think anyone would say $30 would significantly change their life. Maybe $30 in lottery tickets and hit the lottery, certainly that could change your life. But $30 in any investment that I can think of, probably, even the most far outdated option that comes true, probably wouldn't significantly change your life. So I'm going to go to 2 ounces, which certainly $60 wouldn't change your life. So I think I'm well within the realm of a little. The reason I chose those two numbers is simply this. There's roughly 700 million ounces of silver mined every year. A little bit more, a little bit less, depending on which study you use and what numbers you gather. But round numbers, you can up it to 800 million. But quick math, 350 million people times 2 ounces, 700 million ounces. So that roughly covers the entire global silver supply on an annual basis. And yet, This is a small, small number relative to silver's total position. So there you have it. If everyone in the United States bought a little silver, you would be buying the annual mining supply of silver without even thinking about it. However, if you applied it to everyone worldwide buying a little bit of silver, I think you can see my point. The point is very simple. There are a lot more people than there is silver available for investment, and I've maintained that all the way up. What's funny is that the amount of silver that is above ground, that is held already, is in tight hands. So the float, or the amount of silver that's actually up for auction on a daily basis, is not that great. Much smaller than the 700 or so million ounces is mined. Most of that's already accounted for in the future, not so much in the futures market, although you can make that case. The point I'm making is that most of the silver users already have hard contracts in place for silver out in the future that they absolutely need to have supply to them to continue their businesses, be it auto, be it solar, be it chemical. A lot of that silver has already been bought ahead of time. As it comes out of the smelter, it's already got a destination. Back to the saying, everyone should own a little. Not everyone can, and not everyone will. There's a lot less silver out there for investment than most people think.
And that's basically what's happening right now in both gold and silver. If you are looking at what's been going on since we've had the coronavirus shutdowns everywhere, it's shut down, I think it's at least 30, 40, 50%, something like that, of the global mines. And then the mints that produce the gold and silver have been shut down, and the central banks are buying it at record pace. And so you're seeing these huge shortages that major retailers are starting to have. So this is a real life glimpse of the move into gold and silver by ordinary people, and most specifically by big money, China, Russia, central banks, all these big billionaire hedge funds. And it's a real-time look at why it is valuable. And that's kind of what Jim Rickards has always said. He says, nobody wants it until they need it, but by the time you need it, you won't be able to get it. And that's pretty much where we're at right now. Would you say that's kind of an accurate summary of what you're seeing? And what do you think right now about what's going on at the time of making this video? It's April 22nd. We had the big sell-off. Gold and silver went through the floor. I called you almost shit in my pants, and you told me not to sell anything. And you said, if you were me, if I was you, I wouldn't sell anything. And so I didn't. And now I'm up huge now, and you're seeing these big moves. Do you think this is another head fake that's happening? And we're going to go back to, a smaller price in gold and silver. What's your take on the markets? The oil price just collapsed 2 days ago. What do you think about all that?
Well, as far as a short-term call on the metals, I'll probably leave that for paid subscribers like you. But I have noted that the mining equities are following the general equity market primarily. So if we had another sell-off in the general equity market, the Dow, I would expect to see the miners probably sympathize with them again. Will they do what they did on this last scare the heck out of you system? Probably not that bad.
Do you think we're going to see another sell-off right now? Like, you see Mark Cuban said that he's keeping almost all cash. A lot of these big billionaire investors that are on mainstream media are saying the same thing, that they're anticipating another leg down to retest the previous lows.
Well, I think we're going lower in the Dow and the S&P. And I also think that the miners will sympathize with it, but I think they may have seen their low. But we also could see how fast they react, and they're reacting much faster and stronger than they did in the 2008 crisis, which actually manifests in the stocks in 2009. So I'm not too worried, but, I'll probably just do a video soon, Jake, for everybody. You'll see it soon. And, if you're where you are and you have the kind of portfolio size that you and many of the subscribers do, you might consider buying some puts for cheap insurance, or maybe writing some calls and capturing some money. I wouldn't say go to cash, but I would say, be prepared mentally You've already done it once. You're starting to get hardened up there, Jake. Like
I know I am. It's definitely a personal development course, that's for sure.
Anyway, so the other part of oil, I mean, I did do an energy letter for a year. I am fairly well studied, and I certainly don't consider myself to be much of a spokesperson for oil, but I can say this. There's no more important commodity on the planet than oil. Energy runs everything, and cheap energy has been the reason that we've had such a huge population boom worldwide and had such a high lifestyle in what's called the free world and outside the free world, whatever that means these days. But regardless, oil is almost everything. It's energy, and everything needs energy. So with this disruption to the oil market, it's like the most important thing that we have as humans is air. It's like, I would not say taking air away is not a good analogy because you can only go a few minutes. It's more like disrupting the food supply, where you could go probably weeks, and depending, if you're overweight, you could probably go a couple of months, and I'm not trying to make fun of anybody or anything like that. I'm just using, the scientific method. If you've got more calories, you can last longer. The point is that it is a disruption that affects everyone. If the food supply was disrupted, it affects everyone. If oil is disrupted, it affects everyone. How bad? Well, it's again, using the food analogy, depends. Depends where you are. Depends if you're in an area that grows a lot of its own food, then your disruption isn't going to be that big. You might not be able to get certain foods you're used to at the supermarket, but you can still grow what grows in that climate. Oil is similar. If you're in an area that pumps out a lot of oil, and they can't even afford to transport it. They can afford to transport it, but there's no place to store it. They're going to cut the prices so everybody's getting, free gas at the pump as a bit of a joke, but you get my point, I hope. So this is huge, and I am not qualified, and I don't think anyone is, and I'm not trying to be arrogant at all. I'm just trying to be honest. Can really tell you what this is going to do, other than it's going to provide a huge shift throughout the entire system, everything from the banks to the hedge funds to the brokerage houses to the debt markets to the corporate debt markets. It's going to affect everything. Again, just as if the food supply was cut in half.
Why is this? I mean, nobody seems to really be reacting that gnarly to this. Why?
Mike Maloney is. Mike Maloney's called.
But why is this so gnarly? Like for me, and a person listening to her saying, well, why is it? Oh, cool. It should be good. It's cheaper. Why is this? Why is this so gnarly?
Well, it's sort of similar. Another analogy is what's happening now in the financial markets. We're seeing basically a deflationary scenario, which is typical. Even though we're pumping money in, it's not fast enough. It's like having a bucket with the hole in the bottom of the bucket that's this big around, and you're pumping money in with a hose that's that big around. You're pumping a lot of money. That hose is on full blast. And if you just focus on the hose, you say, man, I got this baby turned on full blast. But you're not paying any attention to what's coming out of the bottom of the bucket. That's basically what's going on in the financial system right now. So there's that part of it, which means a deflationary pressure pretty much across the board. There will be areas that react. Gold already sees it, so it's going up. And then you're going to get this backlash where you're going to see a point where, as Martin Armstrong accurately states, in my view, that you're going to get where government fails. People are not going to trust the government debt anymore. They're already questioning a lot of corporate debt, as they should. And he pointed out you should stay away from all municipal debt, municipal bonds, those tax-free bonds that the rich buy to, have a nice income without a tax base on it. So, excuse me. So we're in that situation now, but it will most likely turn into an inflationary depression eventually. That's what's always happened during a time frame where you had a pure fiat system. If you've had a gold-backed system like we had in the 30s, then you can get a debt liquidating depression. We're probably going to have an inflationary depression. But remember, the word depression is on both of those terms. Inflationary depression or deflationary depression, it's a depression. Get that. You can look it up. You can study it. You can do whatever you want. You can argue with me. We're going into depression. How we
What's
get there.
What's an inflationary depression mean?
deflationary depression means that
No, inflationary. You said your personal prediction is we're going to have an inflationary depression. What does that mean?
Eventually, it means that people don't trust the money anymore.
Okay, so then that's like kind of what happens in like Zimbabwe and Venezuela, and that's when
that's a hyperinflationary depression.
That's the most extreme scale.
Yeah, that's the extreme scale of an inflationary depression. Yeah.
Got it.
Because we have the bond market. I mean, everyone up until this day, well, I would say everyone, I certainly don't, but a lot of banks pretend like they trust the debt market still or the credit markets. But in reality, I doubt many of them really do. I don't want to talk over anyone's head, and I'm not trying to, believe me. But the point being is we're probably going to see a deflationary scare that will last for some time. It'll be real. I mean, you're going to see, perhaps car prices and, entertainment and all these things come down in price, but your food prices keep going up. And it's going to be a mishmash, really. But primarily, it'll be a deflationary pressure for a while. And then going back to M.A., Martin Armstrong, you'll get to a point, in my view, and it probably is going to be that long, where you'll get to where, wait a minute, food keeps going up, and I'm making less and less, or I'm only getting my universal basic income. And I need to buy, if I buy a case of baked beans that were up, 20% from the last time I bought them, I can't make 20% of my money in the market. I can make it by storing, food. So, a rush to, buy food or whatever. I'm just creating these ideas as a metaphor for what I'm trying to teach or explain. And that is that once the trust breaks down, you can't get it back. And it doesn't take a majority rule to break down the trust. It takes a very small minority. And then it's sort of the monkey mind. Everyone sees everyone else running out of the, buying peanut butter instead, buying stuff instead of keeping dollars, or what's called dollars.
So this is my personal view as well. Obviously, who knows when it's a very bad scale. I mean, right now we're closing in on 20% unemployment right now. But this is why I've told you a little bit, David, that I've went more into the financial space, and this is on my new financial channel. And for my fans and subscribers and stuff, the reason I did it is because I've seen this coming for a long time, and I've just been silently doing certain things. One of the things we talk about a lot is starting a business. And what I talked a lot about with Mark Cuban the other day, and that's you don't need a lot of money to get going, but everyone's going to need to be an entrepreneur, going to need to raise our income ceilings, get other sources of income, and not be reliant on hopefully keeping a job and old industries still being alive and hoping that the government will save me or have my 401k. So we talk a lot about being an entrepreneur, and this is one of the greatest ways to ensure your freedom. Then the second fold of that, of what I'm personally have a lot of my vast amount of my allocation to, is physical gold, physical silver, and then mining stocks as well. And to me, this is how you protect your wealth. And when you understand, maybe you could talk a little bit about this too, David. What I'm really starting to learn more is the cycles to things, right? And as they keep printing more and more money, and you're seeing these tremendous bailouts, and you're seeing the national debt increase, and you're seeing the money become worth less and less. And right now, presently, the dollar is stronger, and that one is quote unquote staying afloat. And a lot of that is because 80% or so of the world reserve that governments have, they store in cash. So their debt is paid in US dollars. So there's a short term or even an intermediary term. Maybe it's even lasts a few years, but there's an intermediate demand for dollars, for US dollars. And this is what has brought me into gold as well. What are your thoughts on the dollar? And right now you're seeing the mainstream equities US market up, and if they seem to, we're pretty far off those bottoms there, which has been pretty impressive that they've been able to do that with I think Disney stocks going off, and they fired like 100,000 people.
Yeah. Well, here's my view on the dollar. I was one of the first, if not the first, to bring this up to, I'll call it this bull market in precious metals. I actually was having a conversation with Jay Taylor, who's a friend of mine, and started talking about the extra pyramid, and he wasn't familiar with it. And it wasn't me that, I was taught by somebody else about this. And I'd give them credit, but I don't remember. And it's much different now with this drawing than it was the original one, which I have a picture of the original one. I won't bore you with that. But the idea is that the pyramid is the most stable structure on the planet. So that implies that an upside down pyramid is the most unstable situation that we can face. So on an upside down pyramid, let me say it differently. On a right side up pyramid, the base would be very solid, right? The base here is derivatives, which is the most unbelievable situation you can ever imagine. And the derivatives market runs the whole system. And it shouldn't be that way, but that's the way it is. So this pyramid going down, the way my arrow is, goes from the most illiquid.
What the hell is a derivative? Before you go, what the hell is a derivative? Just in 5-second explanation for someone that doesn't even know what it is, because I've only learned a lot of these stuff in the last few years. If I started researching and really studying, so derivative means that so much of the moves in commodities, whether it's gas, gold, or stocks. What's that?
A derivative is derived from the source. So if the source is gold, a derivative would be an option to buy gold. Or if the asset is corn, a derivative would be an option to buy corn, or the ability to buy corn.
This is in every single market there is.
Every single market. And there's derivatives on top of derivatives on top of derivatives. So if your followers have watched The Big Short, when they talk about CDO squared, all they're doing is in that game of 21, I think it is, and they're behind the players, and they're making a bet. I'll bet that she, busts before he does. And then the guy behind her says, well, I think she'll scratch her leg before she busts. And then the guy says, no, I think she'll use her left hand to scratch her leg before she busts. And it keeps going on and on. Those are derivatives of the original, is she going to bust or not? Okay. And that's the idea. So, and that idea is not, is as bizarre as those sound, that's about where we are. So you go from things that are the worst possible situation you can have as far as being able to sell these things because of counterparty risk at the top of the pyramid, in this upside down pyramid. So as you go down, you get more and more solid. You get more and more to what you actually can trust, what you know is really there, what you know is going to be stable. It should be the bottom that's stable, but it's not. So the next one down is like private business, commercial real estate basically in this sector. Don't have to agree with this. Then you've got your corporate and municipal bonds that is talked about and referred to Martin Armstrong. Then you have what's called currency illusions. I don't know if Martin would agree with that, but I'm not doing this for Martin. I'm doing it for me and your audience. But you're looking at, what's really trusted, the T-bill market, government bonds, and U.S. debt. I mean, those are considered to be, and those are far better than anything in the derivatives market, although a lot of the derivatives are based on what these interest rates in this block are going to do. And then you have currency, basically physical notes. I mean, if you're holding, pounds, which, the pound sterling piece note, or a Federal Reserve note, or a euro note, or a yen note, then you've got something you've trusted your whole life. It may have changed whose picture's on it, or may have gone from being like a piece of paper to kind of a plastic one like they are in Canada. But still, that's about as safe as you can get. Cash. And then below that is gold and silver. That's something that's lasted. Remember, every Fiat Fails. So this green stripe here is the most trusted, just slightly less than gold and silver are, because these do fail eventually and have every time. So then there's this move down here. So that's how it works. And we are in kind of this area right now. So when I did all this to teach, I'm doing this as an exercise to really go deep and hopefully make it understandable. So there'll be a run to the dollar. Because if you look at all these other currencies, you know, the euro, well, the euro is a basket case. You've got the Brexit with the Brits. You've got Japanese have been in a basic deflation / depression for 40 years. So everyone's going to the dollar because that's the best place to go. So I could see the dollar and gold going up together, which a lot of my contemporaries say, oh, no, it can't go. They're in the inverse. No, they're not. It's really a trust issue more than anything else. What do you trust? I trust the dollar and I trust gold. And then when they stop trusting the dollar is that point of inflection that I'll call it point of inflection. And Martin Armstrong says that's, there will be a point. And I agree with him, unless I misquote him, and I don't mean to, that the trust of government, the trust of these things starts to end. And that's when the run to gold begins. And it could be other things. I mean, it could be real estate. It could be, but those things are up on the debt markets because almost all real estate is backed by some kind of debt instrument, which is going to be collapsing because it's not going to be trusted. And you don't know if the counterparty can make good on it or not. So basically, there'll be a run to gold. And the run to gold will, of course, be in some of the derivatives, right? An option to buy gold, a futures market, a gold holding company or that kind of thing. But, gold in your hand, gold in the vault, that's your vault type of thing, that will be the ultimate. And so there'll be a run there, but not for a while. I think you're going to see, it's starting now, but the real big run that I'm forecasting, that's not going to take place for some time. And it's not 10 years out. It's probably less than 5. But that's how it works. So this stuff just basically blows up, which causes a lot of this stuff to be impaired as well because of the way the system works on basically interest rates. And then a lot of these corporate muni bonds, as I'm reviewing here, forget about it. This is where the stock market lies. A lot of U.S. listed stocks, pretty solid stuff in the middle here, but not invulnerable to this system that we're in. And then, of course, currency. I mean, you've got all these government secured currencies, but they're only as good as the people that can make good on the payments. I mean, every time the government borrows, they're borrowing on your behalf. They're putting you further into debt. It's your obligation. They call it a government obligation, but it's your obligation. You're the one that's required to pay it back. They just borrow it from the bank. And when they borrow it, they're borrowing it in your name, but you don't get to do much about it. Oh, you might vote left or right, but what difference does that make? Not much, because they just keep increasing the debt no matter who's there. And then you get down to currency. And how much currency is actually in your wallet compared to how much is in the computers? Very little, my friend. So if everybody went for a bank run, forget about it. There are not enough trees on the planet to print that much money. So that's never going to happen. That's why you're restricted from being able to go and get your 10 grand, try to get 5 grand out of the bank. You probably could, but make it hard. Try to get 100,000. You might have $1 million account in the bank. Try to get that in physical cash. Good luck. And then, of course, gold and silver, truly the rare elements that have been money for time immemorial, basically. Yes, there's been seashells and cattle and leather and all this stuff. I know all that. But when it gets down to the truth is that people have voted that real money is gold and silver. It's really that simple. So I've got to run, Jake. I hate to cut you off real fast. I've got a 1 o'clock. I am a man of my word. I don't want to miss this.
Fascinating. David Morgan, thank you very much. Down below, I will put the link for the Morgan Report, and it is not an affiliate link. And like I said, it is super cheap, $50 a month or $500 for the year. Give it a try. Appreciate you coming on, David, and I'll let you run since we are basically at 1 o'clock.
Okay, thank you so much. Bye for now, everyone.
Thanks, David. Dude, that was so great. I'm gonna cut this last part into its own video. That is such a cool chart. I'll let you get going though.
Okay. Well, good visiting with you. I'm been pounded, man. And thanks for doing this. You might just tell them in the show notes, sign up for the